This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Mebane Faber. Mebane, as you might know, is the author of many books. His first, The Ivy Portfolio. His most recent, out right now, Invest with the House, Hacking the Top Hedge Funds. Mebane has appeared on this show before. He brings a different perspective than myself, but we have many, many alignments. The biggest alignment is Meb comes at this, investing, trading, finding alpha from a quant perspective. Today we discuss his newest work plus an assortment of other issues. I'm sure you will enjoy this conversation with Mebane Faber. So let me ask the serious question first, and I will go back to the non-serious stuff. The serious question has to do with surfing. And so I want to know, because I had a friend who not too recently lived a little north of Pacific Beach, a little south of La Jolla, and I got my education, my lesson, not that they confronted me, I'm not a surfer, but I got my little education, my little lesson about the surf gangs along the Southern California coast. So I have to ask, are you a part of one of these gangs that assaults people, cuts their tires, and does all kinds of nasty things because people are out there trying to get your waves?
I think you have to have a certain amount of ability to be in any sort of surf gang. And I am a very average surfer bordering on a beginner. So if there ever was such a thing as a gang, I wouldn't be invited. But, you don't hear about it really anywhere near LA, with the exception of this one little spot in Palos Verdes. It's kind of crazy to think about this day and age, but apparently it still happens. So who knows? I've never seen it in my entire life. So I don't know.
As I was thinking about talking to you today and going through your newest work, I was thinking, wow, the Seth Klarman book. I actually saw it again in my possessions when I was back in the States. This little title that I purchased, I think, in 1993, 1994. And now this book sells for thousands upon thousands of dollars. What a nice little investment, huh?
There was times that when I was a young, poor guy right out of college, where anytime I saw a used bookstore, would try to find an old copy and have never found one. But I used to arbitrage some of the old Ned Davis books back in the day. Those used to go for $500 or so. Never seen Margin of Safety in the flesh. Have read it and enjoyed it. I don't know if it's worth $1,000, but to each his own.
It was a 5,000 print run, and he never did any more, is what I understand. So.
Yeah, why would you? If you have the lore of it, every time he gets written up, they mention that his book goes for $1,000. So I would probably sell it, but who knows? I'm a cheapo.
Let's jump into the meat of this. So I really relate to one of the things that you talk about, which is you say, look, the markets are not efficient, people are not rational, but there are some serious pros out there that win and beat the so-called market. And of course, this has been a motivating driver for me forever. But we're kind of like running in parallel here, slightly different chasing of strategies, but a very similar foundation and framework. Talk about your inspiration. Why some of these big name guys just motivate you so much. I'm sure we're going to share very similar beliefs.
If you think about markets, there's a number of different approaches that work. If you studied markets long enough, you know that value investing works and trend following works. I mean, there's no debate about that. I mean, even buy and hold investing over long enough periods works. Having the ability to be somewhat objective and honest about it, I think is really important. But let's rewind for a second. So back in 99, I was an undergraduate at University of Virginia. I was a biotech student, engineering guy. but had always loved investing, and that was really my hobby, my passion, and grew up with a family that encouraged talking about stocks and investing and business in general. In my spare time for some of these classes, when I wasn't taking biology or engineering, I was really interested in economics and investing and finance. There was a class that was taught by a Julian Robertson, so Tiger Management, one of the biggest hedge funds in the world in the 90s, I think peaked at maybe 25 billion in assets, maybe 30, I can't even remember, but one of the biggest at the time ever, massive run of incredible performance. One of the true hedge funds, what you think when you think of hedge funds of, those decades, the 70s, the 80s, and the 90s, the long short stock pickers. So picking stocks long and shorting bad ones. He ended up growing into more macro stuff. But anyway, I digress. So his right-hand man was a hedge fund manager, but also taught classes at Columbia and the University of Virginia, named John Griffin. And he now manages $5-10 billion of his own. And he's one of what's called the Tiger Cubs. And there's all sorts of progeny from the Tiger sort of tree. But anyway, so he taught a class called security analysis, and you had to actually apply to get into the class. I found out too late, so of course, missed the application deadline. Saw that someone had dropped out the day before, so just showed up on the first day of class. And they said, well, there's no room. But I said, hey, look, there's a spot open. If this person never shows back up, can I sit here? And they said, fine, sure. So it was a really incredible class because each week, a different hedge fund manager or investor or famous reporter would sit in and be like a Q&A guest lecture. So really a lot of the famous investors that people have heard of, we used to sit there in class, a lot of the students, it was all finance people except for me, but all good friends of mine now. And actually, ironically, there's probably 3 or 4 pretty famous hedge fund managers from that class today that grew out of it. We used to print out the holdings of the managers before the class, like any diligent student would, to see what those managers held so that we wouldn't say something stupid in class and be embarrassed. What a lot of people don't know, if you're a money manager with over 100 million in assets, you have to publish your holdings. It's each quarter. There's some caveats to this, but in general, they come out each quarter. There's a 45-day delay. So the end of the year, 2015, the holdings will come out February 15th. And so we used to look at the holdings to get a heads up of what they were talking about. But, and this is a long-winded answer to your question, but what you would sit there and listen to these hedge fund managers, these billionaires, and they would talk about, hiring people to spy on oil fields in the Middle East, or having their analysts sit outside of a store and literally count the number of people coming out of the store for the entire day for weeks on end, to get an edge. And a lot of this has been arbitraged away, but this real, what they would call value-added research. And I said, my God, these people have way more resources, way more understanding of finance, and we would do all these accounting case studies, and I'd never taken an accounting class in my life. So I would say, why wouldn't I just let them manage my money? Why wouldn't I just pick the stocks that they did? But being a quant, being a objective guy, I can never get comfortable with that theory until I tested it. And so it was actually another 4 or 5 years before I was able to work on that project, and a couple poor interns, where we finally got the data sets and said, all right, we know who the Michael Jordans of finance are. Is it possible to go and actually track these guys and kind of piggyback on their stock picks? And the good news, after many months of doing this by hand, downloading all these SEC documents, it turned out that actually there was a lot of gold nuggets there.
So you had become a trend-following trader of the value managers.
And one of the challenges of this world, though, is there's a couple assumptions we say in the book that need to be valid. One, you got to believe markets aren't efficient. But if you're an efficient market person, you probably aren't listening to this podcast anyway. And 2, you say you have to be able to identify these Michael Jordans of investing. And it was always my belief that that wasn't that hard. You know, if you look at basketball and say, well, why is it the hedge funds? And you say, well, because the hedge funds attract the highest compensation. You know, where do you make the most money? So where do you find the best basketball players? NBA. You know, the best basketball players aren't playing in Europe. But if you look at the NBA, you say, look, who's the best players? And we may disagree. We may have some arguments, but pretty much Steph Curry and LeBron James will be on everyone's list, et cetera, right? It's not that hard to identify the talent. So the same thing with investing. Now, there's caveats, and we talk a lot about this in the book. So I put out a new book a couple weeks ago called Invest with the House that's on this theory. Anyway, we've looked at the data starting in about, I did this in 2005. You can even go find the old post back on the blog. And I took about a dozen managers that my friends and fund of funds managers had suggested, and we went and tested it. And it turned out, yes, you could actually follow what these managers do. And so the perfect example that we always start with, because everybody's familiar with him, is, of course, Warren Buffett. You know, one of the most famous stock pickers of all time, one of the richest people in the world. He's been managing money ever since he closed his hedge fund many decades ago under the Berkshire Hathaway umbrella. We said, could you follow his stock picks? So we'll take the top 10 stocks each quarter, rebalance it when they're public. So 50 days after the quarter's in, we tacked on another 5 days just so there was no issues. How would that do? And turns out, back to 2000, which is where the electronic data really started, you can actually go to the SEC reading room in DC and take this back to the 70s. And there's been some academic papers from Cliff Asness at AQR and those guys that actually took this back to the 70s. And it turns out he just had this basic, what one could call a trend following piggyback strategy, absolutely destroys the market. So if you just take it back to 2000, that simple strategy, top 10 stocks, equal weighted, you know, I mean, you know the names, IBM, Coca-Cola, et cetera, beats the market, I think, by about 6 percentage points a year. And it turns out that would beat 98% of all stock mutual funds in the U.S. back to 2000. And the best part is you don't have to pay any fees.
As you clone Buffett, though, as you clone Berkshire, this is a pretty mechanical approach, though. This isn't Mebane sitting back on the seat of his pants, making discretionary decisions about what you think. You have actually made this a pretty standard approach for each of these various managers that you talk about in your new work.
Right, and there's a lot of pros and cons. Look, I'm a quant. We try to be as honest as possible about the benefits and drawbacks. So futures don't show up. You're not going to get the shorts. This is a long-only portfolio. You shouldn't be cloning the managers that have high turnover like SAC or the high-frequency guys. You can never clone the CTAs of the world, commodity trend-following guys, because they trade futures, or someone like a Renaissance. But the Buffetts of the world, the Seth Klarmans of the world, whose real value add is stock picking, you can, it turns out. And there's some really funny stories going along with this. So we profile about 20 managers in the book, and then another 15 or so in the appendix. But we actually published about this topic, you know, on the blog in 2006, and in my first book, Ivy Portfolio. And it's funny because I was actually listening to your interview with Barry, our friend Barry Ritholtz, a week or two ago, and it was fun to finally, you know, get to hear the tables turn and you be the you know, interviewee rather than interviewer. But you had a great comment. It was something about publishing or getting things out there, and it was talking about just, you know, getting art out there, just going out and doing it. And that's what this book kind of represented for me, because I'm not selling anything. I don't benefit from this. I'm not making any money from this book, but it's been in me for so long, and there's so much misinformation on this topic. My God, if I hear another journalist talk about why you can't do 13F research, name of the SEC form, my head was going to explode. A lot of these managers are characters. But so you can build this idea farm. You can take a stable of managers, pick your favorite 5 or 10. I love Baupost. He's one of my favorite. For those listening now, it's probably an awesome time to be allocating because he's in a fairly significant drawdown for this portfolio. But I also gravitate towards the managers whose name, the stocks they pick are very atypical. And one of the worst things you want, and one of the worst ideas, is cloning the funds where it's the very popular hedge fund names. So the names that exist amongst, the broad hedge fund space, because you don't want the beta of the hedge funds. You want the alpha. But let me tell you, here's the challenge with this strategy. And it actually goes back to being the challenge with any investment strategy. So let's look at Buffett, for example. So back to 2000 has absolutely creamed the market by 6 percentage points a year. However, most of that performance came in the 2000 to say 2008 period. And since the global financial crisis, he's underperformed the market, his picks, in 7 of the last 9 years. And so if you're a money manager or you're allocating to someone, and let's say you just started allocating in 08 or 09, how much leash do you give those people? Maybe it's a year, maybe it's 2 years, but 3 years of underperformance, certainly not 4. And so the biggest alpha of Buffett, or the alpha of many of these managers, this applies to trend following, macro too, is the ability to stick with a strategy for an entire cycle. Buffett, look at this strategy. If I could tell people, hey, you're going to beat 98% of equity mutual funds, you're not going to pay any fees, you're going to beat the S&P by 6 percentage points a year. However, you're going to have to sit through 7 of 9 losing years in a row. Of the last 9 years. Most people could never do that. And that's the same thing with trend following, right? You go through these peaks and valleys of performance, and that's why most investors are their own worst enemies. So this type of strategy, it certainly appeals to a certain type of person, but it's funny because you'll hear people that will allocate, they'll go buy a mutual fund and say, hey, I'm gonna buy this fund, and this is an actively managed fund, which 70% of mutual funds are. But they say 13F investing would never work. That doesn't make any sense to track the manager. I think it's a wonderful starting point, or entire outsourced portfolio, but I'm not trying to convince anyone. We're just putting info out there, and hopefully
well, there's no doubt. There's no doubt. You definitely, as a guy like me, I read it and I say, wow, what Mebane's really getting at is, I've got all this cool data and I want to give it to my audience. I want to give it to people because it's so cool to me. Let me make a book out of the data, which I also relate to that concept, having frankly done many books about trend following by simply starting with the data. That's mission critical.
And that's part of the beauty, is that, the way we started was doing it by hand. So you learn some things that probably a lot of the people that work on 13F investing never learn, such as the largest holding is often not their best idea. People assume that the largest holding in a portfolio would be their best idea, but because of the delay, and because the largest holding is often the largest holding because it has already appreciated, holdings 2 through 10 are much better choices than number 1. So it makes a lot of sense to just swipe number 1 away. But you also find things that are pretty funny in the data. For the longest time when I started doing this, I could never figure out why one of the best performing hedge funds of our era didn't clone well, why you couldn't follow this fund. And the results were just abysmal. And the fund turned out to be Galleon, which is one of the biggest frauds in hedge fund world. And so had you been doing the 13F research, you would have said, this is weird. I don't understand why his stock picks are so bad, but the fund is doing 30-40% a year. Well, it turns out it's because he was insider trading and trading around earnings announcements, and actually the regular portfolio was actually pretty terrible. That's also another benefit of the 13F investing. You don't have your money locked up. There's no fraud. The taxes of hedge funds are one of the most tax inefficient vehicles. So you could do this in your IRA. You could do this on your own and tax optimize it. But you also don't have any lockup. So there's a lot of and by the way, the biggest is you don't have to pay the 2 and 20 fees to a lot of these managers. We actually have cloned some funds where the 13F portfolio actually beats the underlying manager because you're not paying this huge amount in fees.
Let's talk about why most people can't go the direction that you are proposing. Because ultimately what we're talking about here, and you quote Buffett as saying it, hey, you got to stick with the strategy. And you just talked about sticking with something where, 7 7 out of 9 years down. How hard is that? And this brings us right back to something like, Daniel Kahneman's work, which, a lot of people give lip service to, but there is a massive, massive human downside to being able to, hey, look at all this great research that Mebane Faber is giving me, but I really can't stick with it because I'm human. I mean, the psychology part of this is massive. It's just huge.
Well, let me give you a couple just examples, and there's reams of academic data that shows that people are their own worst enemy and underperform somewhere between, let's call it 1 to 3 or 4 percentage points a year by buying, at the wrong times and emotionally selling at the bottom over and over again. And the funny thing is, a lot of my institutional friends, think that they're better at this than the individuals. And, the people running the big endowments or the big pension funds and money managers. But I've also been going to a lot of these conferences long enough to know that there's plenty of groupthink there as well. And so I just posted a study to the blog the other day that showed hiring decisions. There was something like 8,700 hiring decisions across 3,700 policy portfolios in these big institutions. What we're talking about, the real money, the CalPERS of the world. And what it showed was that the manager firing and hiring decisions. So a manager gets fired, a new one gets hired. So they looked at the performance of the new manager coming in for the prior 4 to 5 years before he got hired, minus the portfolio, minus the performance of the manager that's getting fired, and then the future returns the next 5 years. And sure enough, the manager coming in destroyed the outgoing manager for the 5 years prior. And going forward, ironically, the one that's getting fired outperformed the one that they just brought in. Because what's happening, of course, these institutions are doing the same exact thing as individuals are doing, which is panicking, selling, chasing performance, and doing the worst possible behavior. So this ripples into so many different areas. They just use more sophisticated terms. It may be called, much more rigorous, or there's, consultants that are doing these studies. Same exact damn thing. We looked at all these asset allocation portfolios. So it doesn't really matter if you're a buy and hold investor, how much you have in stocks, bonds, and real assets. But what does matter is you stick to the allocation and you don't pay a lot in fees. Well, it turns out if you go and chase the best performing allocation every 5 or 10 years, which is what most people do, think of emerging markets and commodities today, everyone that had said they really want emerging markets and commodities as a buy and hold investor absolutely don't anymore. But if you went and updated the portfolio every 5 or 10 years with the best performing portfolio of the prior 5 or 10 years, you would have cost yourself an average of 1.5% per year returns. So there's all these examples of people just being human and doing these really dumb things, but it's tough. And I gave this speech last week to a group in Arizona, and a pension fund manager says, well, Meb, what do you recommend? How can you build a system that will keep us from doing dumb things? And I said, well, the challenge is there's a lot of competing forces. If you're a committee member and, your endowment is underperforming Harvard or Yale or all these others, there's a ton of pressure. You may get fired. They may bring in new consultants. Same thing as if you're a money manager at Morgan Stanley or an individual. If you're underperforming or you own commodities and own emerging markets for the past few years and they're getting crushed and your client's saying, why in God's name do we not just own U.S. stocks and bonds? Well, it's much easier to just sell them and keep the client than it is to do the right thing and say, no, this is the plan. This is our policy portfolio. This is what we're doing. This is our system. So there's a lot of competing forces of career risks and misaligned incentives. But it's tough, if you look at right now, I did a post on the blog today. U.S. stock sentiment is hitting one of the lowest levels it's hit ever in the American Association of Individual Investors survey. So AAII, it's in the bottom decile of people being bullish right now. And that's no surprise. But if you look at the extremes, it happens at the worst possible times. When were people most bullish? Literally the worst possible month to be bullish in the history of the survey, January of 2000. When were they most bearish? literally the worst month, March of 2009. You couldn't pick a worse time to be super bearish. A lot of it's wired in, and look, I have all the biases, and it's one of the best things about learning that and making terrible trades and making mistakes is you learn that over time and put in, a system or fail safe to keep you doing dumb stuff.
Let me get you to unpack something. I don't know if you'll want to go there. You mentioned going to the conferences. You have many friends in this space. I want to be clear. As far as I understand, most of the pensions that still exist in the U.S. are generally public pensions. So these are usually public employees, whether it's the local, state, federal level. Most corporations, most people working for companies, whether it's Walmart or whatever, they don't really have a pension. That stuff's long gone. So what we're really talking about are public employees. And I find that this disconnect between the guys at the ivory towers at the top of whatever XYZ pension, like a CalPERS, and the person that puts their money in or it's just taken out of their check each month, there's a massive disconnect that end user doesn't understand that the people at the top are yes, their motivations are to quote make money for the people in the pension fund. The career risk element of it, that seems to, it's always unnerved me. It's always made me uncomfortable because I will frankly admit that I have met many people that work for the public pensions. And I usually don't walk away with the same feeling that I have when I talk to a trader or a fund manager who runs his own fund for clients. It's a completely different mindset.
And one of the challenges is that our business, it's a lot of its history, is learning what has happened in the past and understanding quite a bit of history of markets. I don't think that a lot of the people that are involved in our industry have bad intentions. I honestly don't. Wall Street, look, it attracts the worst of the worst. But so does every industry. But one of the challenges is that I don't think most people necessarily have bad intentions. They just may not be in a role that's designed for what it really requires. And so a great example is almost every pension fund or endowment or retirement plan, whatever you want to call it. Yes, there's not as much defined benefit anymore. But in general, a lot of these plans have these 7-8% return assumptions. And there is zero chance they're going to meet that number over the next 10, 20 years. One of the simple reasons is that inflation is low. So you lose the benefit of getting a few percentage points of inflation. So at 8% return, when you have 4 or 5% inflation, is a lot easier in 10% bond yields than when you have almost no inflation and a 2% bond yield. And so if you look at the top quant shops, so AQR, Research Affiliates, GMO, all of these, even Vanguard, Bogle came out last week, and even Bridgewater, largest hedge fund in the world. Almost across the board, these say a diversified portfolio, buy and hold, is going to do low single digits. So let's call it 4%. Let's be generous and say 5%. Bogle, I think, said 4. There's no way to do the math to get that up to 7 and 8. Now, I don't think they're being malicious. I just think that it's really tough. There was a great quote. Charlie Munger was talking where he said he was talking to an investment buddy of his. This is back in the day, but I'm talking to an investment buddy, and he said would often tell his investors that he expected a 20% return on his portfolio. And Charlie Munger said, that's crazy. That's impossible. There's no chance of you getting that. And that. Why would you say that? And he says, because if I don't tell them that, they'll never invest with me. Well, there's a lot of these sort of misaligned incentives. I don't know necessarily that people are malicious, but I also don't think they're necessarily forward thinking of, hey, look, this is a 10, 20-year sort of scenario. Maybe we can design this a little differently. And that's one of the not look too different effects is you don't see a whole lot of trend following allocations in the big plans. You may see some, but you don't see, if you were completely blind and given a bunch of asset class risk and return parameters on note cards and not told what they were, most of these plans would have about a third in trend following CTA type of strategies. We wrote an article on the blog. It was actually, I think, the most popular or second most popular article I wrote last year called The Trinity Portfolio. And a near impossible portfolio to beat is a third in U.S. stocks, or global stocks, excuse me, a third in global bonds, and a third in trend following type of strategy. Doesn't matter whether it's managed futures, whether it's a relative strength and trend, whatever it may be. That's a really great portfolio.
So I have to learn some of these diplomacy skills that you have. You're much nicer at probably keeping some friends than I am. I think I can sometimes probably cause some people to say, I'm not listening to that guy anymore. Hey, listen, let me go into I want to go into some of the lists. And I also saw on your Twitter feed a bunch of questions that came in too, which I thought some of those would be fun. But I would love for you to just give some, even though it's not really the thrust of your newest work, I would love for you to talk about some insight or some big picture thought that you can pass along to some of these very famous names in your book. What can you tell the audience about just a big picture, something concrete they can wrap their arms around and walk away with and say, okay, I understand that man a little bit better. I understand where he comes from, where he's going. Why has he been so damn successful?
If you look at all these investors, typically they have their system, and it may not be totally quantifiable and objective, but these guys have often been doing it so long that they have a very specific system of how they invest. And they'll often, if you look at some of the docs, they'll say, this is what I look for. I look for free cash flow less than this, and sales outstanding on inventory, like all these little characteristics, which is kind of like a quant screen. And going back to that AQR paper about Buffett, they said, Buffett's magic was not that he's that incredible at picking stocks. I mean, you could clone his portfolio with some simple factors, low valuation, high quality, low debt, all these other things. But, his ability to stick to his system, which is pretty amazing to think about it. Because if you look at Berkshire, it's had multiple 50% declines. So the ability to sit through this value type of investing, and so every 10 years or so, you'll hear Buffett, has lost it, and you're hearing it right now. You heard it in the late 90s, but it's the same sort of thing. Can these guys, whatever their methodology may be, stick to their system? Now, where you start to see the drift, and this is one of the biggest difficulties, I think, with following active managers, is at what point do you cut them loose? And so there's a lot of sort of squishy, type of characteristics. Have they gotten too big? Are they going through a messy divorce? Are they resting on their laurels? Are they having style drift? David Einhorn is a great example. He's been a phenomenally successful investor, particularly in the first half of the 2000s, but he started to have a little bit of drift, or he starts to get into macro. He's starting to, invest in gold and all these other things that are not his traditional wheelhouse. And that actually happened to Julian Robertson in the late 90s, where he started to get into a lot of other areas that may not be their forte. And there's no firm set of rules on how to fire these guys or say, you know what, I'm going to no longer track this manager. And this is why it requires a little domain expertise. But once they stop following whatever their system may be, and each one is different. You'll read in the book, some of these guys, want, this type of stock with this type of characteristics. PAR is one of my favorite ones in the book. A fairly unknown hedge fund, but one of the most successful track records across the board that specializes in certain industries. And so if you saw them starting to move into other industries, you'd say, okay, well, do they hire a new analyst or what do they do? So there's some really fun ones in there, but it's a constant research process with trying to unearth, the next Buffett.
Let me throw some Twitter questions at you, because look, people are going to have to go read the work. You cover a lot of names, a lot of different thought processes. You got to dig in. We can only talk about so much of that fun stuff right now. I thought one of the cool questions that I saw posted on Twitter today in advance of this conversation, I think a guy was in Singapore and he basically said, my market's too small. I'm paraphrasing. My market's too small. What should I do? Because he only wants to invest in his country. For the life of me, if you're in Singapore right now and you're only thinking about investing in Singapore, what the hell's happened? The streets are paved with gold there. You should be able to sure as hell invest in markets far beyond the borders of Singapore.
One of the biases that I'm sure we've talked about in podcasts past, is the home country bias, where people invest most in their own market, and it happens everywhere. So I just gave 2 speeches. I've done this the last dozen speeches I've given, where I'll pass around a piece of paper. I say, write how much you have in U.S. stocks as a percentage of your total stocks. So no bonds, no commodities, no real estate, just stocks. Within a few percentage points, it's always around 70. So I would tell people, I'd say, hey, it's going to be 70. And then I'd say, what's the average? I'd have someone in the audience calculate it. They say it's 69%, 68%. And the U.S. as a percentage of world market cap is only half. You were making a very active bet that the U.S. is going to outperform. Well, first of all, kudos if you've been doing that the last 8 years, because it has. But it's a coin flip versus U.S. versus foreign equity markets. What's going to do better? But the same thing happens everywhere. So the Brits, the Italians, the Aussies, everyone has this home country bias where they put most of their money in their own market. The Asians are the worst. All the Asian countries have a very strong home country bias, investing most of their money in their own country. And that's a horrifically bad thing to do if you have an asset allocation portfolio. There's no reason to just focus on your own shores. And so we talk a lot about evaluate global stock valuations, particularly now. I've been beating this dead horse for a year or two, saying the rest of the world is cheaper, and in certain pockets it is vastly cheaper. And historically, investing in the cheap countries has done much, much better than investing in all the countries, and that's done much better than investing in the expensive ones. Absolutely better. The worst thing you do is buy the really expensive ones. And so the U.S. right now, so the way the world looks, and we've been saying this for a while, is that U.S. stock market's expensive. It's not a bubble. It's not crazy, but it's one of the more expensive countries in the world. Let's call it 43 out of 45 developed and emerging countries. But the good news is most of the world is average valuation all the way to downright super cheap. So you can buy a basket of these countries. So for the guy in Singapore, you can go out and buy a basket of countries that, first of all, you buy a global allocation, that's fine. But if you tilt it towards value, you'll do better. Now, the caveat, of course, is that valuation can always get cheaper. We all know this. I mean, if you look at cheap countries, they can get cheaper. This is one of the cheapest the cheap bucket has been since 09, 03, and the early 80s. That's a pretty good subset of times to invest in global equity markets, especially the cheap stuff. So we're pretty bullish on foreign doing better than the U.S., particularly bearish on the U.S. We wrote an article called 11 bearish charts, one bullish one last spring. And it listed all these reasons you shouldn't be investing in U.S. stocks and said, you know what? It doesn't matter. There's one reason that the market that trumps all the other. It's the Queen of Spades reason why you still have to be long, and that's the trend. So the trend trumps all these other factors, and then just updated it in fourth quarter end of the year and said, actually, now it's 11 bearish charts, 0 bullish, because the trend on the U.S. has gone negative. So my advice to the person in Singapore, I've never been, I would love to go. So tell them to organize a nice CFA talk. I'll hop over. But is look beyond your shores. You have to be investment agnostic. As much as I love the Denver Broncos, as much as I love, my home team, you have to be agnostic when it comes to investing.
So hold on, you're going to Japan. How long are you going for?
Probably 2 weeks, maybe.
Okay. And is there a really tight schedule that you have to race back to the States?
It's not too tight. I haven't booked my ticket yet, so I'm...
And so everyone in Southeast Asia, from KL to Singapore to Saigon, everyone knows you're only a 6-hour flight away. You should be showing up on the shores, taking a selfie, and proving that you've at least been to Singapore. It's only a 6-hour flight. Come on. It's a simple credit card charge. You just do the round trip. It brings you right back to Narita. It's easy.
It's funny because I've been talking about these global valuations around the world. Was in a lot of South American countries over the past few years saying, look, I love your countries, Mexico, Bogota. And I said, however, your stock markets are really expensive. And was not quite booed out of the room, but people would pull me aside afterwards and say, this is why you're an idiot. This is why these markets can't go down. This is back when oil was, up and around around $100, I think $80, and they're like, look, can't go down. Pension funds are putting all this money in. So it wasn't much fun to give talks in all these places. Finally, this summer, I was giving talks in Eastern Europe and in the Baltics. I said, finally, I can give a talk somewhere. And I had to give in the U.S. too. Expensive. Finally give a talk in these countries. Said, by the way, so happy to be here. I can finally say that your markets are cheap. But no one cared. At that point, their stock market's down 50, 60, 80. In Greece's case, 95%. They said, there's just blank stares in the audience. We don't care. So I would love to give talk because there's a lot of Asian countries that are actually getting pretty cheap. But hopefully I'll be well received. But I don't know. I don't know if anyone is exactly opposite of what you would hope, but it is, I guess, what you would
Let me give you a couple more and I'll let you run. So I also caught another tweet and I took this completely different because I did not recognize who the author was, but he said, what's your take on the latest trend following treatise from Jesse Livermore? Now, I did not click on the Jesse Livermore Twitter handle, so I had no idea who it was. I just thought it was pretty clever because I was like, well, the latest trend following treatise from Jesse Livermore, well, Reminiscences of a Stock Operator is timeless. So I thought that was very clever, but apparently there must be somebody actually associated with this that has some newfangled view on something or another.
Well, you will have to actually. It's a great blog. It's an anonymous blog written by a guy that I know, but he puts out great research. He is data driven. Will often say, "Look, I'm gonna let the data talk." Has been pretty positive on trend following posts. The one thing that I give him a hard time for, I think a lot of people, is his often some of his blog posts are as long as my books. So I need someone to curate his blog post. But he's had some great research come out, one of which was a post in the last year or two that has been picked up a lot. And it was a simple chart from the Fed data that showed stocks as a percentage of household assets in the U.S. It kind of floats, as you would expect, through market cycles, but it's often kind of highly correlated to what's just going on with price. So people end up owning more stocks after a big bull market because they've simply gone up. But it has one of the highest correlations you've ever seen to future stock returns. It's like 0.94. It's inverse, of course. So when the percentage of stocks of U.S. households is high, future returns are low. And when they're low, the future returns are high. It's not surprising. But so it doesn't use valuation as input, doesn't use anything else. It's just how much do people own. And sure enough, right now is one of the highest times it's been in the entire sample back to 1950. So it's also predicting low single-digit stock returns in the U.S. But it's kind of funny because it has nothing to do with valuation or anything else. It comes to the same conclusion. Totally different piece of data.
I had a lady on my podcast recently, Stanford professor Kathleen Eisenhart. She's got a book out you've probably read called Simple Rules. And boy, you just give a great example of a simple rule. I mean, sometimes people want this massive complexity to try and figure out a way to find that alpha, but sometimes it's just damn simple. The hard part is the human part.
Yep.
So where can we send everybody? The book is out. They can find it right now. Invest with the House, Hacking the Top Hedge Funds. Mebane Faber.
Yeah, you can buy it on Amazon. The ebook is reasonably priced. The physical, it was a very difficult decision for me where I could have published it black and white for a lower cost or color, all interior color, for a higher cost, and it looks so much more beautiful in all color. I decided to publish it in color. So if you're a cheapo investor like me, go with the ebook. If you think if you want a more of a coffee table read, then go with the physical color.
Oh, the physical book is color. I'm doing the same thing on my next one. I love that.
It looks so much better. It's hard to go back to especially if you have a lot of charts and graphs. It's hard to go back to the black and white.
Remind everybody of the website where they can find out more about you. You are quite prolific.
You got Mebane Faber for a lot of the blog posts, or Cambria Funds for our ETFs. And then, of course, if you want to watch Michael and I pick fights on Twitter, then at Mebane Faber on Twitter.
Meb, thank you. Take care, sir. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.